Warren Buffett rarely invests in real estate because the management is very complicated, it's almost impossible to scale, there are also some tax implications for Berkshire Hathaway. However, he has shown his willingness to invest in REITs in the past. He's held positions in quite a few different REITs, and one of his most recent and largest REIT investments was a company called STOR Capital. He invested in the company in 2017, he then doubled down in 2020, but recently the company got bought out by a private equity player. This has left us all wondering what would be his favorite REIT in today's market. Hey everyone, this is Jussi. I run an investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about Essential Properties Realty Trust, which is essentially an improved version of STOR Capital. But before I get into it, if you could please like this video, it will help me a lot. Thank you very much. So Essential Properties Realty Trust, ticker symbol EPRT, is a triple net lease REIT that invests in middle market companies just like STOR Capital. The difference to a net lease REIT like Realty Income is that Realty Income is going to buy properties that are occupied by very large tenants like Walmart, Dollar General, McDonald's. EPRT and STOR are instead going to target triple net lease properties that are leased to much smaller tenants. And the benefit here is that because these tenants are much smaller, there is much less demand for these properties, and so they'll be able to buy these properties at much higher cap rates of 7 to 8%, whereas Realty Income is only going to get 5 to 6% in most cases. Then they're also going to get higher rent escalations of 1.5 to 2% compared to around 1% for Realty Income. And then they're also going to be able to write their own leases with landlord-friendly terms. You know, because everybody wants to buy these properties that are occupied by Walmart, the tenant is going to hold much more bargaining power, and so the lease terms are typically going to be very friendly to Walmart. But with these small tenants, it's the opposite. And so EPRT is going to be able to structure really friendly leases to the landlord with long terms of 15 to 20 years. Typically the property expenses, including the maintenance, are the responsibility of the tenant. Then they're going to add master leases with a lot of properties under one lease to mitigate the risk of lease defaults. They're going to remove force majeure clauses and a lot of other things. And so this approach can be really rewarding. You can just look at the track record of STOR Capital from its IPO up until the pandemic. It massively outperformed the rest of the REIT sector. And so EPRT has the same business model as STOR Capital. It was even created by some of its former executives, but there are three key improvements here. Number one, they focus on smaller properties in most cases. STOR Capital owns some very large properties such as Bass Pro Shops, and those can be quite difficult to release in case of issues. And so EPRT is mitigating this risk by focusing on small properties that are much easier to release in case of issues, and they're also more liquid if they want to sell them someday. Then the second improvement is that they focus on more generic layouts. And so again, the benefit here is that in case of troubles, if your tenant goes bankrupt, there's a much larger pool of potential tenants to release this property. And then the third thing here is that they focus on a smaller range of just 16 subsectors. And so they'll avoid things like bank branches, movie theaters, which have some property obsolescence risk. And so when you incorporate these three improvements to STOR Capital's business model, EPRT is able to reduce its investment risk. And despite this, it has actually been able to massively outperform STOR Capital since its IPO. I expect this strong performance to continue in the years ahead because EPRT is still a very small REIT. I'll put a comparison of its size to that of STOR Capital on the screen. It also has a very strong balance sheet. It has some of the lowest leverage in the entire triple net lease sector. And so I think that it has very attractive external growth prospects ahead of it because it's earning sector leading spreads. It's able to bump up its leverage in the future if it wants to. And so not surprisingly, in 2023, it's expected to have the fastest growth rate of all net lease REITs. And so this is why I think that EPRT would be Warren Buffett's favorite REIT today. It used to be STOR Capital, but it got bought out by this private equity player. But EPRT is essentially the same REIT. It follows the same business model. It was even launched by some of STOR Capital's former executives, and then it was improved further with all the lessons learned at STOR Capital. EPRT is today actually one of our largest REIT holdings at Leonberg Capital, and the reason why we invest so heavily in it is because it It has a very consistent and predictable business model, but despite its lower risk profile, it's able to generate these double-digit total returns with its near 5% dividend yield combined with a 5 to 7% annual FFO per share growth rate. Now, if you want to learn more about all the other REITs that we are buying, feel free to join our REIT newsletter for a 2-week free trial. I'll put a link in the description below. And otherwise, let me know what you think in the comment section below. Always happy to chat with you. Please like and subscribe. Thank you very much. See you at my next one. Bye.